Hi, I'm Grant Stevens.
And I'm Chris Bernier.
And we're the two investment guys. This week, Chris and I want to turn back to the markets, talk about some of the things there. You know, when we look at how the markets have started this year, we see the Canadian markets up about 3%, major US markets up about 6% so far this year. London's up 6%. And interesting, the Far East market, major market in Tokyo, Chris, up 9%. That has a little bit to do with some currency stuff over there as well. But you know, January was a good month, and if you're hearing anything about something called the January effect, it's a sort of a statistical review of what happens the rest of the year in a good January, and many times the year ends up being a good year. Mm-hmm. Now, having said that, that doesn't mean it's smooth sailing from here. It's just an interesting thing to look back on. But we want to talk about a couple of our usual things. Chris, why don't we jump into some of the earnings down in the U.S.?
Sure. Well, if we look at the U.S., we're about 3/4 of the way through S&P 500 earnings. 69% of companies have beat analyst estimates. Mind you, some of those estimates have been lowered. The long-term beat ratio is about 65%, so we're right in the range there. I would say, broadly speaking, the trends that we're watching in the U.S. is a continued improvement in the housing sector, improvement in the automotive sector, and that's leading to a continued improving trend in employment. But when we look at Canada, Grant, it's a bit of a contrast.
Yeah, it's a little bit different story up here. You know, we have a weaker housing market. It's pretty pockety. And also our employment trends have been a little more holy, you could say, a little lumpy along the way. And we've been hearing some things from some of the analysts a few months ago that said, you know, the Canadian market is going to stumble around a little bit here based on housing and employment numbers. And that's in fact what we're seeing. Now, our wild card here in Canada, of course, is China. It's such a large consumer of raw materials that we're a big producer of. I mean, frankly, 50% of our stock market is materials and energy. So what happens in China really matters to the Canadian markets, Chris.
Sure, absolutely. And we have seen an improving trend in China as well, which kind of bottomed near the end of the summer last year. If we look at what we're doing now, a couple of trends to keep an eye on is a continual drift higher in bond yields. Now, why is that important? Well, we reached about a 3-decade low in interest rates last fall, and you want to talk to your advisor about your fixed income part of your portfolio. Make sure that you've got a fairly short duration in your bonds, and just make sure that it's tightened up a little bit there. The other trend that we're seeing is the U.S. equity markets continuing to outperform Canada.
Yeah, so we're looking for opportunity, and if the Canadian market is going to be bumpy and a little tight, then we call it sticks, rocks, oil, and gas. That's our market. Mm-hmm. We look down to the U.S., which is probably the broadest market on the planet for opportunity, and there's far more opportunity down there on the equity plays anyway, Chris.
Absolutely. I want to thank you again for your questions and comments. Please keep them coming. You can contact Grant and I at twoinvestmentguys.com.
Join us next time. Chris and I are going to continue our discussion around some of the dynamics in the capital markets. So until then, I'm Grant.
And I'm Chris.
And we're the two investment guys.